Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hengan International Group Company Limited annual report. Hengan International Group Company Limited offers a diverse range of businesses and services across various industries. The company's primary focus lies in manufacturing, distributing, and selling personal hygiene products under multiple brands. These include pocket handkerchiefs, sanitary napkins, baby diapers, enemas, feminine intimate wash, first aid, adult care, and household products. In addition to its core business, Hengan International Group also engages in trading various products for ladies, pregnant women, infants, babies, and kids. The company distributes disposable fiber-based products and provides consultancy services. Furthermore, it is involved in e-commerce, trading, and procurement activities. The company's product portfolio extends beyond personal hygiene products to include heat and power, gas, papers, protective equipment, medical instruments, skincare, cosmetics, adult diapers, facial cotton, antiseptics, and daily personal necessities. This indicates a broad scope of operations, catering to various needs and markets. Hengan International Group Company Limited market capitalization of $32 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Hengan International Group Company Limited holds a significant advantage in their industry. Hengan International Group Company Limited trades at a higher price-to-earnings ratio of 13 times and a higher price-to-book ratio of 1.35 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 5.39%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the given summary. On one hand, several factors contribute to revenue growth. E-commerce and new retail channels have been instrumental in driving sales, with premium products such as Tianjin cotton and Hardex experiencing significant demand. New product launches, consumption upgrades, and evolving parenting concepts have also contributed to revenue growth. The aging population and rising awareness of health and hygiene have further boosted sales. The company's effective value competition, strategy, category diversification initiatives, and efficiency gains from omnichannel sales have also played a crucial role in driving revenue growth. Additionally, the expansion of new retail channels, increased demand for premium and functional tissue products, and diversified product needs have contributed to the company's revenue growth. On the other hand, several factors have led to revenue decline. The hygiene products market has experienced a decline in sales efficiency due to intense price competition. Industry competition, aggressive promotional strategies by domestic brands, and stronger sales in traditional channels have also contributed to revenue decline. However, it is worth noting that these drivers of revenue decline are being mitigated by other strategies, such as the company's effective value competition strategy. In terms of specific business segments, tissue products have experienced a significant growth of plus 15.2%, while hygiene paper products have declined by minus 4.3%. The core business segments, tissue and hygiene products, have grown by plus 1.9%, with operating profit increasing by plus 3.9% and profit attributable to shareholders growing by plus 10.3%. Overall, the company's revenue growth is driven by a combination of factors, including e-commerce, new product launches, consumption upgrades, and effective business strategies. Net income has experienced a significant increase of 10.3% to Rm535,047, indicating a positive trend in the company's financial performance. This growth is expected to remain stable in the first half of 2026. Profit margins have undergone changes, with both gross and operating profit margins showing fluctuations. The gross profit margin has improved from 32.3% in 2024 to 33.8% in 2025, while the operating profit margin is implied to be plus 15%. However, there was a decrease in gross profit margin from 60.4% in 2024 to 58.3% in 2025. The reasons behind these changes can be attributed to several factors. The growth in tissue paper sales has offset the decline in hygiene products sales and promotional expenses. Additionally, premium high-margin products have maintained their growth, mitigating the impact of raw material price fluctuations on gross profit. These factors are expected to contribute to an improvement in profit margins through the allocation of promotional resources, increase in premium product sales, and enhancement of sales performance. The company's financial performance indicates a significant milestone. One of the key indicators of a company's health is its ability to generate positive operating cash flow. This means that the company is able to produce more cash from its core operations than it spends on various expenses, such as salaries, rent, and equipment. This achievement is a testament to the company's efficient management and effective strategies in place. The generation of positive operating cash flow allows the company to invest in growth opportunities, pay off debts, and reward shareholders. It also indicates that the company has a strong foundation for long-term sustainability and success. The company's debt level has undergone significant changes over the past period. While non-current liabilities, such as borrowings and lease liabilities, have seen slight fluctuations, current liabilities have experienced more pronounced increases. Specifically, borrowings in current liabilities have risen by RMB 4,947,928, while derivative financial instruments have appeared for the first time with a value of RMB 14,360. As a result, total debt has increased to RMB 15,734,060. In contrast to the rising debt level, interest expenses from borrowings have decreased by RMB 188,929, and total finance costs incurred have dropped by RMB 217,184. This suggests that despite the increase in debt, the company is paying less in interest expenses, indicating a potential shift in its financial strategy or market conditions. The company's financial records reveal a consistent payment of dividends to its ordinary shareholders. As per the provided documentation, the company paid RMB 0.7 as an interim dividend in both 2024 and 2025. Furthermore, the total dividends recognized for distribution to ordinary shareholders were RMB 1,626,970 in each year. This indicates a clear commitment to rewarding shareholders through dividend payments. In contrast, there is no evidence suggesting that the company has engaged in share buybacks during this period. Concerns have been raised regarding the accumulation of inventory due to significant changes in the company's stock levels. The data indicates a substantial increase in the allowance for inventories, rising by RMB 34,358. Furthermore, the changes in finished goods inventories have seen a notable surge from RMB 7811 to RMB 393,931. These figures suggest that the company may be experiencing issues with inventory buildup and potential supply chain disruptions. That concludes the financial summary for Hengan International Group Company Limited. Feel free to comment below, and I will be happy to answer them when possible.